In market news now, Asian stocks fell for a second consecutive session as global investors contended with signs of a softening U.S. economy and were in full flight from U.S. regional lenders ahead of an expected U.S. interest rate hike later this evening. Locally, one of South Africa's largest suppliers of chicken to fast food outlets and restaurants, Astral Foods has flagged a plunge in interim profits. This was on the back of record high feed input costs, the electricity crisis and the decay in municipal infrastructure, which drove up costs and hampered the poultry group's operations. The chicken supplier, valued at 7.3 billion rand on the JSE, said it expects its headline earnings per share and earnings per share to drop 87% to 92% year on year respectively. For more, we are joined by Jones Gondo, who is from Nedbank CIB. Jones, thank you so much for your time. In anticipation for that all-important Fed meeting later this evening, or rather the announcement, how are you interpreting local and global market sentiment?
Look, I think everyone is in a holding pattern because there's just a whole lot of uncertainty about how deep any rate hikes are going to be. I think the expectation is 25 basis points, and it will be a surprise if they don't hike. And if they go higher than that, then I think the big concern is we'll just accelerate a recession and a global recession sooner. And I think the local market is taking cue from that as well.
So you look at Astral Foods' trading update and probably even the other announcements we have gotten from the other, call it primary food producers. But in the case of Astral, reminding us once again how difficult the poultry industry actually is.
Yeah, I think there's one common theme across all sectors is that we're all starting to take stock of electricity production challenges from Eskom coming into as a big cost input into a lot of these producers. And we also know from previous data about how high food inflation is driving headline inflation in South Africa. And so that's starting to manifest into producers such as Astral, amongst other sectors. But I think this one was quite a significant profit warning.
The one thing I find fascinating is you look at the platinum price, which has recovered. However, when you look at the byproducts of the platinum, rhodium, for instance, they're moving in different directions. So when you look at the local listed PGM companies, what kind of reading are you getting there when you look at the share prices?
Yeah, look, I think it's a mixed bag. For those that are typically South Africa exposed, Northern RB Platinum, they are getting knocked on share price. There was a corporate action between RB Plats and Northern that concluded without any real particular outcome, and so that hurt share price and sentiment. But generally, they're all reflecting higher costs, all-in sustaining costs, due to load shedding and load curtailment and low sales. So the load curtailment hurts their production, and they're all trying to play catch up on production, and so the sales are down. But like you said right in your introduction, that rhodium, palladium prices are moving different to the platinum spot price. So the basket in general prices are down for platinum group metals as a basket. And I think the outlook that we had at the beginning of the year is playing out in that we were concerned about operating costs and would rather play the metal prices themselves. But we take it through the cycle. I think the one upside for these stocks was that we were hoping for a much stronger China reopening and demand for auto sales to sort of drive platinum prices. But that is also playing with a lag effect at the moment.
One of the words that was quite popular last year, at least in the market, was recession. We spoke about it quite intensely last year, and going into this year, probably even now, we're even talking about the possibility of a recession. When you look at the performance of the different asset classes, is there an indication at all that we could be heading to an economic meltdown?
I wouldn't go so far as to say a meltdown. I think one thing that played last year is that indicators are now starting to really show that the global economy is certainly slowing, and that the pace of rate hikes is now starting to have significant consequence. But I think the issue here is just more about looking at different asset classes. Is that demand generally is particularly in the US is starting to take a dive, and job openings yesterday's data proved that. When we look at oil prices, they compared to the beginning of the year, they're down. I mean, Brent crude is sitting at $75, and when you look at that's on commodities. When you look at just the other subsectors. Particularly the financial services index, credit is a big aspect of driving growth and an early warning indicator of slowdown and recession. That is also turning down, amongst the fact that you've got mid-tier banks in the US that are struggling with asset or interest rate risk, should I say. So I think all the indicators for financial stress in the financial conditions index are showing and flagging to authorities that high rates are working their way through subsectors of the economy, and that's why we see headline indices like the S&P and the Dow Jones have been taking a knock for that.
Jones, thank you so much for your time. Let's leave it there. That is Jones Gondo from Nedbank CIB. That is it from me. Over to you, Francis.